Let's get in, Mayuresh. Mayuresh, good morning and thanks for joining in. Let's start with Tech Mahindra. Your view going forward.
Morning, Agam. As far as the results are concerned for Tech Mahindra, the expectations that were laid out largely in dollar terms, the result in terms of the dollar revenue degrowth has come in better than what the street was probably expecting. So I think a general consensus anywhere between 8.5 to a 10% kind of a drop quarter on quarter. The drop was only 6.7% quarter on quarter. So I think that was one positive takeaway that the stock that Tech Mahindra has probably done. The second element in terms of the active client list, that has moved up with 8 clients coming into the fold on a quarter-on-quarter basis. And the cash and cash equivalent stand at 1,378 million odd dollars. So yeah, I think in terms of what the expectations were on all these parameters, including the EBIT margin, which got reported at 10.1%, it's relatively better than the expectations of 9 and a 9.5% kind of range. Now, again, if you probably look at the outlook going forward and the expansion of margins, probably because of the one-off effects in the base quarter itself, you're coming back to the core business outlook itself. So communication still forms 43% of their business, enterprise around 57% as well. Now, with the global developments taking place, specifically in terms of the bans that are expected by a lot of developed countries on why, what probably happens for software providers and what kind of a capex spend will come through, specifically on the 5G side, that probably needs to be seen on how that landscape plays out. The second element, obviously, is its BPS business. So the business process services business also needs to be understood on the traction that it will gain in the coming few quarters as well. The larger term outlook obviously is looking fine, because I think the deployment over the next few quarters and years towards 5G, cloud, automated services that will probably require artificial intelligence, that will have accelerated spends from the client end. On the enterprise side of the business, again, I think the automation and the robotic processes is something that Tech Mahindra has an upper hand with. So in the interim, there might be some issues related to how autos will function. But our own take is, and our own emphasis in terms of our US team's research is that the second half in the US markets in pandemics and specifically after crisis periods throws out huge opportunities in energy, banking, and the retail and manufacturing space. Where I think most of these major IT companies are present. So yeah, I think the earnings have beaten consensus. As per our own canceling parameters, it is a little bit way off in terms of the pivot levels. But again, I think the stock should react very, very positively in terms of the expectations and what they probably delivered at this
point. Okay. That's Tech Mahindra for you. When we move on to Nestle, well, Nestle is going to announce earnings today. Now, among the FMCG companies, we've already seen Britannia with very strong earnings. Nestle is also expected to report steady numbers. That's because of demand for prepared foods in a time where there is stringent lockdown measures which were in place. Of course, a lot of that has eased up now through the course of the quarter, when we may see growth across the segments as far as the first quarter is concerned. Mayuresh, very quickly, your expectations on Nestle and perhaps your outlook as well, considering the kind of valuations it has always been trading at.
Oh, absolutely. So the valuations have always remained heady for Nestle. And a large part, as rightly pointed out, Agam, specifically during the lockdown and even now that we are witnessing the need for prepared dishes. Maggi, right? I think the consumption of Maggi, biscuits in general, if you're probably looking at atta, namkeens, I think that have increased multifold because I think people probably have a lot more time to probably consume all these items together. Milk and nutrition, however, form the largest part of Nestle's overall top line, anywhere between 45 to 47 odd percent. Prepared dishes, which includes Maggi, having the largest component, is second best at 29 odd percent. And what you've probably seen in terms of chocolates and confectionery, I think even the last financial year, the value and volume growth was quite significant. And there are no two ways of looking at how the balance sheet is. Very, very strong balance sheet. Margins remain extremely robust, anywhere between the 23 to 25% kind of range. The negative working capital is something which abets the entire return ratio profile that the company reports. So ROEs, ROCEs on a core basis in excess of 80, 90 odd percent, which shows the superior balance sheet strength that Nestle carries. Again, I think the kind of new products that they've probably introduced, even though small in terms of a percentage contribution to the top line, are expected to significantly contribute, and they've done pretty well in terms of new launches as well. The realization also has increased year on year, and that probably also lays an emphasis that the management is also focused on profitable-led realization growth. So largely, again, I think it has outperformed a lot of its peers in terms of sales growth, and the direct reach is something that they're probably striving to achieve on a much larger scale, which will probably bring in much more operational efficiencies. And again, I think the cost measures that they'll adopt, maybe I think constrain a little bit of the ad costs, which lie between 6 and 7 odd percent in the current period, and focus more, as I said, in terms of volume-led price growth. This is probably a given. Supply-led issues, logistic issues, they would probably be now behind as a lot of operations are getting rationalized and normalized as well. So valuations have remained heady. They might still remain heady, assuming the kind of balance sheet growth and the dynamics that it has. So it's an individual take. As per our Cancelim parameters, I think this is a quality stock, a leader within its space itself. So any further price strength, I think, should be looked at in a positive sense. But yeah, I think on a global scale, I think we do remain positive on this story.
Okay, fair enough. And from there on, we move on to the AMCs. Now, we've had earnings from two very large AMCs, HDFC AMC and Nippon India Life, which has announced earnings. We all know that the earnings haven't been great. In fact, both these companies have seen revenue declines come through for the first quarter gone by. However, what also stands out is the retail segment has countered the weakness to a certain extent. And we all know that there has been a lot more in terms of retail participation in capital markets in general over the last quarter or two. Taking all these factors into consideration, Mayuresh, at the end of the day, we're still seeing some weakness. We expect some sort of a recovery overall.
No, so I think it has to be looked at in a holistic picture for all these asset management players. And I think 2, 3 broad aspects that probably stand out is within the total assets under management that they've got. What is the share of equity assets, debt assets, and the liquid funds, along with the PMS and other advisory services that they do manage? It's a known fact that equities and equity-related services are high-yielding products, and therefore I think the entire AUM mix probably gets tilted towards equity in terms of revenue accretion and the yield generation as well. Now, what you've probably seen in terms of the past few months, SIPs have probably still remained very, very strong, and therefore the retail participation has remained extremely critical for these players. However, the share of equity within the overall AUM mix has dwindled down for both these players, which automatically reduces the yield perspective that both these players report. The second element, obviously, is the kind of distribution share and from which sources do they garner their funds. Now, IFAs still have a majority, at least for Nippon India, I think more than 50 odd percent. For HDFC AMC, it still lies at a dominant share of more than 40 odd percent. So I think how do they entail that there is direct participation coming through, which also has a lot to do in terms of rationalizing the costs at their end, is something to be seen as well. The third element, obviously, is that the commission costs have come down drastically over the past few quarters, ever since the SEBI regulations have come through. Therefore, I think the kind of business model that they operate out of, once they've reached a scale, which a lot of these asset management companies have, the fixed costs are very well absorbed at this point of time. It's a matter of time in terms of how market direction is. If they're able to shore up equity AUMs to a large extent, the yield factor improves. And how do they manage their costs? And a lot of these companies, Agam, are actually doing a lot of digitalization efforts, which will basically mean that once that part of that capex is done towards digital initiatives, I think the cost curtailment will happen even more larger and on a profound basis, which might have a telling effect in terms of how the entire cash flows and bottom line growth will be. So I think it's a large construct on how these companies operate within the current underlying environment at this point of time. But largely, I think it does depend upon market conditions. Valuations stack up a little bit heady for HDFC AMC. Nippon probably is comparatively less cheaper compared to HDFC AMC. But I think concerns still persist in terms of how the overall performance might still be. We need a consistent trend going forward, and volatility probably does not help either the asset management players or investors in terms of the consistency that one probably perceives these players to.
Okay. All right. Fair enough, Mayuresh. We leave it at that. Thank you so much for joining us and taking us
Thank you so
through
much.
those stocks that we've discussed today.